FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and well, it's New Year's Eve day. We want to wish all of you out there a happy, healthy, prosperous new year ahead. I have a feeling it's going to be really exciting, and in some good ways and in some bad ways, but this could be the year. So get ready. What do you think is going to happen in this new year? We're going to talk about that in a moment, but we'd love to hear your predictions. So please email us, kl@kerrylutz.com with your New Year's predictions. And John Rubino, dollarcollapse.com, and I have got a few of our own here. First, we're going to talk about some pressing issues, John. So what about Trump? He's just about has this whole thing set up that virtually nothing can go wrong to interfere with his reelection.
Hey, Kerry. Isn't that funny that you can say that while he's being impeached? That's how irrelevant the impeachment thing is. It's all set up. Yeah, he really is in a good position compared to most presidents in an election year, because usually there's some big economic problem, which is really the issue in presidential election. And right now, employment is in pretty good shape. The top line economic numbers are positive. He's working on a trade deal with China, so he's got amazingly, Donald Trump can run for a second term on his record. Who would have thought that was going to be the way that it worked out? But yeah, he can, but that, of course, it's still a ways away. I mean, in 10 months, an awful lot can happen in the world. And then things like a stock market crash or some kind of geopolitical event can change people's perception of the environment in which they're living very, very quickly. So, there's tons of time here still. And there's a whole campaign to run. So there's no guarantee of anything. But right now, compared to the way most presidents have had to approach re-election, he's in pretty good shape.
Hey, well, you and I both big fans, admirers of Martin Armstrong. And, I look back at my notes, and April of 2011, I think, was when I first started interviewing Martin. He had just been released from his unjust captivity. And he said that the market was going to go up, I think that point, 32,000 or 39,000 was his first call. And at that time, John, the market was 12,000, and no one in their right mind believed that it could keep going up. And then it was going to crash when Trump was elected. But all along, Martin has said it's going to keep going up, 39,000, 52,000, whatever. He thought it would happen a bit faster, but I don't really care about that because he's been 100% right about the length, intensity, and duration of this bull market in stocks. And, I doubt the stock market's going to do Trump in. I don't see much really in his path. Yeah, I mean, we could have a major systemic credit blow up that far eclipses what happened in 2008 and 9. That could very well happen, but my bet is on Trump. He seems to be the luckiest guy we have ever seen hold office.
Well, Kerry, when you say we could have that kind of a credit crisis, it's guaranteed that we will. It's only the timing that's in question right now. And there are a couple of reasons for thinking that it might be sooner rather than later. Just came out in the Wall Street Journal in the last week. They ran 2 articles. One was about how capital is pouring into the riskiest categories of junk bonds now, closing the spreads up between extremely risky and not so risky bonds. And that's a late cycle event. That's how it usually goes, right at the end when people have seen relatively good times in their markets for such a long time. And they they want to try to find ways to continue to make money, even though everything is up, and they start looking at riskier and riskier stuff. And right now that's happening in the junk bond market where people are buying, almost bankrupt company bonds, and taking them to yields that imply a lot better times ahead for these companies with, the buyers of these bonds have no way of knowing that. And another even more important development in the credit market is that the credit rating agencies are once again starting to relax their rating criteria in order to get business, because people who issue instead of asset-backed bonds now it's CLOs, collateralized loan obligations, that are sort of the subprime mortgages of this cycle, and that's where the action is. At the rating agencies. And so they're starting once again to compete for issuers' business by being willing to give high ratings to crappier and crappier paper. This is straight out of The Big Short, that movie. There's a scene where a couple of hedge fund guys go to visit Standard & Poor's to find out why Standard & Poor's keeps giving AAA ratings to bonds that the hedge fund guys are convinced are really,
garbage,
really risky and are on the verge of defaulting. And so they meet the Standard & Poor's executive, I guess, and she's functionally blind. That's a little bit of literary overkill there, but she's got these dark glasses on. She can't really see or anything. And she tells them, I'll just read the quote here. If we don't give them the ratings, they'll go to Moody's right down the block. If we don't work with them, they'll go to our competitors. Not our fault. It's simply the way the world works. It is not my decision. I have a boss. And these hedge fund guys are astounded to hear a rating agency executive say something like that, because the rating agency's job is to give unbiased opinions about the creditworthiness of financial paper, and to find out that it's basically a competitive market in which the rating agencies are doing whatever they have to do to get deals done is a sign that the market is close to the end of another credit cycle. So we're seeing the same thing now as those guys saw back then. And it's basically put in the same terms. These credit agencies need to get business from the issuers of these risky bonds, and they're willing to basically lie in order to get that business, which means a lot of really crappy paper is coming to market that is rated as if it's relatively safe. and that means that a lot of the really credulous buyers out there, pension funds and bond mutual funds, people who really ought to know better, but
they
people who don't are buying this paper. Yeah.
Hey, they should know better. And these rating agencies, look, at least, with female or male prostitution, you kind of see what you get. With this type of prostitution, you don't know what you get till years later when you come up with a financial, STD, and you're screwed because your paper is worthless. And if you remember in The Big Short, and in Margin Call, it was like all these Swedish pension fund managers and all of these hapless insurance company executives are buying all this crap. And, these guys, when it collapses again and these bonds become worthless, John, they ought to just march them all off to prison. All of them.
Well, this is a form of fraud, right? And it was last time around as well, but nothing really happened to those guys last time around. It was probably a lot of the same people working in these rating agencies as worked there back then, because it wasn't that long ago. And they're doing the same thing. So, yeah, the really frustrating thing about this, well, there's several really frustrating things about this, but, the biggest one for the thing that's coming is that a lot of this paper is ending up in the accounts of people who are going to need that money in the not too distant future. In other words, pension funds are set up to pay the pensions of retirees. For instance, if you're a teacher or a firefighter or a cop, that's how you're going to live when you retire. But your pension fund is buying this crappy paper, not realizing its likely to default because the rating agencies are lying to them about the quality of the paper that they're buying. And that's going to end up hurting a lot of people who really don't deserve to be hurt. If you're a teacher and you're paying into your pension fund, you're playing by the rules, you're doing what you're supposed to do, and you expect the money that you've been promised. Well, you're not going to get it. And part of the reason you're not going to get it, that's not the only reason, but part of it is that the pension funds are being conned into investing for you into things that are not what they seem. And it's the rating agency's fault. It's their job to stop this. And even if it costs them business, even if they report a couple of years of weaker earnings, that's their job. That's what they're supposed to do. They're supposed to lose business towards the end of a credit cycle because they're the ones who are leaning against the wind of, got to get the deal done at any cost, or otherwise the economy will tank. And if they don't do it, then there's nothing stopping Wall Street from producing a tsunami of really terrible paper that is not worth its face value and is going to default and is going to ruin the lives of the people who bought it. So when the rating agencies behave this way, that's a sign that we're towards the end of the cycle. So, and of course, I've been saying we've been near the end of the cycle for
You've
5
said that
years
for a
now.
while.
My
here, John.
God, this stuff is just unsustainable. We're at the point now where we're so far down in the barrel that there's not much more to scrape out of there. When you're rating CLOs, which are commercial real estate loans, at the peak of a cycle, commercial real estate tanks in recessions. When you're rating those bonds AAA, or when a lot of the other paper out there that is basically cyclical and is basically going to go the same way of CLOs is also rated highly, and we're buying it in our accounts. That's basically the end, because there's not much you can do beyond the riskiest junk bonds and asset-backed securities that are backed by commercial real estate. There's nowhere to go from there. So that means we're probably close to the end, because once the deal flow stops in the bond market, or at least the riskier end of the bond market, then the economy necessarily slows down because crappy companies can't borrow anymore. And so that's one of the big financial risks to the economy out there, that nobody will be willing to borrow or to lend money to the riskiest companies. And those companies tank, and then that spreads to the rest of the economy. That's what happened with subprime mortgages. So basically now it's just a search for this cycle's subprime mortgage. And we're seeing some examples of it out there. It would shock me if the financial markets still feel like they're in good shape at the end of this year.
Yeah, well, it's just been going on for so long. You got to wonder how much longer they can pull the wool over everyone's eyes. We were talking about like Steve Jobs had this ability to distort reality around people. And the current occupant of the White House seems to be able to distort that reality field almost as well.
Well, Trump is a persuasive guy, but I think the real source of the reality distortion field in modern finance is the central bank printing press. If you can manipulate interest rates, you can fool people into thinking all kinds of crazy things, right? Because if somebody's willing to lend you a bunch of money at a really low interest rate, you feel creditworthy, and you feel like the economy is working for you instead of against you. And so you spread that across all of society, junk bond issuers, corporate borrowers of all kinds, car buyers, home buyers, and everybody thinks they're creditworthy, and they borrow against assets that they shouldn't be borrowing against. And so it blows up on you. But while it's going on, things feel good, even though they're not good. And the ability to manipulate interest rates is how we are fooled into thinking that way. And you got to go back to 1971 really for the source of the dysfunction that we're still living with right now. When we went off the last vestiges of the gold standard and gave every major central bank an unlimited printing press, they've been fooling us ever since. And that's why the amplitude of the booms and busts get bigger and bigger, because they have to fool us in a more extreme way each time in order to get us to borrow enough money to cover the bad debt that was taken on in the last cycle. And now we're at the point where the amount of money that's being borrowed out there is just insane. It's astronomical. So when the next downturn comes, which it will come, and it will probably come pretty soon based on the action in the riskiest part of the debt markets, this will be bigger than 2008, 2009. It'll be a bigger crisis. And because of that, a lot harder to get out of, assuming we can get out of it. And if we can't, if we cut interest rates to negative 2% and it doesn't work, then that's the end of the game. And it will be brutal for all the people who were fooled or who had their representatives like pension fund managers be fooled by this sense that things are actually much better than they are.
Yes, I'm afraid that is the case. And we're just going to see more of this. But again, because it's a speculative boom, I hesitate to use the word bubble, John.
I'll use it. It's definitely a bubble.
This thing could, but that's the thing about bubbles. You don't know when they're going to pop. Yeah. And yes, there are indicators, but generally with bubbles, it's only after they pop that you really know that, oh yeah, we were in a bubble, because we knew for the real estate bubble, we were in a bubble. And we know for the stocks, individual stocks, a lot of them haven't gone up that much, but the big ones, the FANGs and all them, have just rocketed off to oblivion, and they're still going up. So at some point, it's got to end. But when it happens, so that the rest of the world learns that we actually were in a bubble, I don't know when that day is coming.
FSN Radio. It's all about what's next.
Today's show is brought to you by U.S. Gold Corp. U.S. Gold Corp is a U.S.-focused gold exploration and development company advancing high-potential projects in Wyoming and Nevada. U.S. Gold Corp has consolidated a district on Nevada's productive Cortex trend and is advancing the Copper King project towards production in Wyoming, led by a team of prolific company builders and renowned explorers, including Dave Mathewson, who is directly responsible for several major Nevada gold discoveries. U.S. Gold Corp is well-capitalized and has an extremely tight share structure with less than 20 million shares outstanding and trades on the NASDAQ, a major exchange, under the ticker symbol USAU. To learn more, go to usgoldcorp.gold. That's usgoldcorp.gold.
The Financial Survival Network. It's all about what's next.
Well, that is the thing about bubbles. They go on way longer than they ought to. And frequently it's only what everybody who's been talking about a bubble just shuts up because they're sick of having to repeat the same thing and having people not believe them anymore that the bubble bursts. But this one is, there are peak of the bubble activities out there that we just talked about in the bond market and definitely in the stock market. I saw a headline. I'm not sure. I should have read the article because it sounds unbelievable. But the headline was that the market cap of the FANG stocks in the aggregate is now bigger than the market cap of Germany's entire stock market. Mm-hmm. And if true, as MSNBC likes to say, that is also a sign of a bubble. When a handful of stocks are more valuable than entire major company stock or country stock markets. That was true in the tech stock bubble back in the day. And it was true with other assets in the 2000s housing bubble. And now we're back to that same kind of situation where we can point to these overvalued financial assets and say, look at them compared to this giant thing over here. There's no way that should be true, but they are more valuable than this other big thing. So we're, Carrie, we are close. We are really close to some kind of a catalyst taking this thing out. And there's no way to know what. And yes, there's no way to know when, but damn, this can't go on much longer.
Yeah. And we look again. Oh, so one thing we wanted to talk about is gold is back over 1,500. Silver has not yet broken $18 an ounce, but it's broken 17. It was down in the mid 16s, high 16s rather. And both of them have gone up. The things that I'm really watching, platinum is getting back to approaching 1,000. Palladium, it's a pretty unmanipulated market, at least in terms of gold and silver, the way it's manipulated. Obviously, Putin manipulates it, but palladium, is 1,700, and it's probably going to break. Or rather, it's 1,900. It's going to break 2,000 before gold does. Who would have thunk that? And another metal that I totally watch because nobody understands it, nobody cares about it, is rhodium, which is used in catalytic converters and also in fountain pens. And so when you look at that and you say, rhodium, who cares about rhodium? But rhodium's at 5,600. It broke close to 6,000 last week. And, these other metals, which are somewhat have precious metal attributes, are starting to go a little haywire here. And yet gold and silver been very subdued.
Well, gold and silver had good years a good year in 2019. And now they're still rising. They're having a good December. So the question is this just seasonality kicking in, or is it fundamentals, or is it both seasonality and fundamentals? Because fundamentals are great for gold and silver. You got all the central banks of the world on the same page now. They're all easing. You got all the major governments of the world running really big deficits now, like bottom of recession level deficits as a percent of GDP, and certainly in nominal terms. But we're at the peak of a cycle now. So they're kind of trying to preempt the next recession with massively easy money. That's a good environment for precious metals because there is a lot of extra credit out there sloshing around that can flow into safe haven assets. And so we're seeing that now. And then we're also entering the time when the Asians do all their gold and silver buying in anticipation of spring weddings, where they can give gold and silver jewelry. So you got those two things combined, and that makes January a pretty interesting month, because normally gold and silver go up in January no matter what else is happening in the world just because of Asian buying. And now we've got really good fundamentals in the form of extremely easy money out there at the same time. So it's possible that we have a good few months ahead of us because those two things are going to create kind of a feedback loop where they feed off of each other. Then the question is, what happens later? Is it sell in May and go away again in the spring? Should we just book our profits in precious metals in February and then walk away? Or will the fundamentals come to dominate this market and give us another really nice upcycle? Because the last two big upcycles in precious metals were spectacular at the end. They went parabolic in the last year or two, in the 1970s and then in the 2000s. So if this is another long upcycle, we don't want to be out of precious metals until the parabolic part happens. So it's an interesting intellectual challenge right now, how to handle your gold and silver, especially your mining stocks, if you've got gold and silver miners, because they tend to be really volatile. And if we have a good January in precious metals, you see the miners really spike. Then the question is, do you take some profits? Do you put a bunch of good until canceled sell orders for a spike in them, or do you just let them ride? And I don't really know, what I'm going to do this time around, because the last thing you want to do is be a gold bug for year after year after year and then get out too early, right?
Right.
Because you endured a really grinding wait when you could have been in Google stock and Netflix and stuff like that. And the only thing that makes that worthwhile is if you were there when silver goes from $30 an ounce to $75, or when gold goes from $1,500 to $3,000 or whatever. You got to be there for that, which means you have to somehow avoid taking all your profits before it happens. But by avoiding taking profits, then you set yourself up for a round trip because of seasonal factors.
Yeah.
So it's not an easy thing to think through and to decide what to do about. But that's what everybody's thinking about now in the gold and silver market is how much longer do we ride this? And what do we do about seasonality versus fundamentals? So a topic for an ongoing conversation for us all the way through January, for sure.
For sure. And probably most of February as well. The things usually start mid-December and carry through to the end of February. When it happens, 80%, hopefully we're not going to be in one of those 2 years. The 20% that it doesn't happen, my gut feel is it's starting to happen, but we need a little more proof. And right before the New Year's holiday isn't where you generally get the proof. Volume's low. The A traders are out of town. It's the B and C traders who are manning the desks now. And you have shortened trading days. All these factors, like tomorrow is going to be a shortened trading day. I think it cut out like a couple hours early, certainly for Wall Street. So it's very subject to manipulation, and you can see gyrations after the first of the year and after that first week, because the first is falling on a Wednesday. So this week is really shot for gold. So you have to look at next week on that Monday, what happens. I could be proven wrong because it could still go up here, but it looks like it's being leveled off and easily capped. It's only up $4 today, and gold, silver rather, is getting close to 18. Anyway, John, we got to wrap it up, but make sure you go over to dollarcollapse.com, sign up for John's newsletter, go over to financialsurvivalnetwork.com, sign up for ours, send us your emails with your 2020 predictions. Let's see if your vision, your foresight is 2020 as opposed to your hindsight usually being 2020. Bad joke there. Anyway, John, Happy New Year. We will catch up with you in 2020.
See you next year, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.